The second reading on equity valuation tries to tell us the various return concepts. Please note this reading is important. A lot of the reviews presented here will be very new, so make sure you listen carefully and you understand every aspect. So, holding period return is simply defined as the ending value minus the beginning value plus the cash flows upon the beginning value in the holding period. The holding period could be 1 day, could be 1 year, could be 10 years. The formula still remains the same. It is not annualized or it is not adjusted for time. It is simply how much we bought it for and how much did we sell it for and what is our return. The cash flow upon the price is referred to as the cash flow yield, and the increase or decrease in price is referred to as the return from price appreciation. The required return is the minimum expected return an investor requires given the asset's characteristics. It can be derived from the capital asset pricing model, or it can be derived from the opportunity cost or any other method. The expected return can be greater or lesser than the required return. If the expected return is greater than the required return, then we say that the asset is undervalued. If the expected return is lesser than the required return, then we say the asset is overvalued. We generally expect the price to converge to its intrinsic value. Hence, the expected return is equal to the required return plus the convergence to intrinsic value, where V0 is the intrinsic value and P0 is the current price. So if I buy the asset at its current price, then the return will be the required return plus the return from convergence to its intrinsic value. If this is positive, we will say the asset is undervalued or the intrinsic value is higher than the current market price. If this is negative, then the expected return will be lower than the required return, as the intrinsic value is lesser than the current market price, or this difference is negative. The discount rate is another rate that we use. So the objective is just to tell you the different rates of returns that we hear about. So we know what holding period return is, we know what required return is, we know what expected return is, can be greater or lesser. The discount rate is the rate used to find the present value of an investment. Many times it can be similar to the required return. It must incorporate all risks of the investment. The internal rate of return is the rate that equates the present value of the cash flows to the current price of the investment. So if markets are efficient, the IRR should be the required return, or the required rate of return and the internal rate of return will be the same. Now, very importantly, to calculate the required return, we need to first estimate the equity risk premium. The risk premium is the return over the risk-free rate that investors require for holding securities or for holding equity risk as a whole. So not for a specific stock. This is the risk premium for the market. So generally, instead of investing in a diversified bond index, if I invest in a diversified equity index, then I expect a higher return to the extent of the equity risk premium. The risk premium can then be used to compute the required return for stocks. That is, the required return would be given as the risk-free rate plus beta times the equity risk premium, where beta gives us an indication of the systematic risk of the stock. That is, whether it is more risky than the general market or is it less risky than the general market. So if beta is equal to 1.2, that means our stock varies 1.2 times the variance of the market. If the market goes up or down by 10%, our stock on an average goes up or down by 12%. The question is, how do we estimate the equity risk premium? At level 1, we were never asked this question. We were always given the equity risk premium and we had to apply it into our formula in the CAPM method or to compute the discount rate and then go ahead. We will now try to understand how this equity risk premium is derived for the various markets. The first approach is the approach of historical estimates, that says that the equity risk premium is simply the historical average return on the index minus the historical average risk-free rate, and that is what you should use as the risk premium. So select any equity index, a diversified index, S&P 500 or the Nifty 50. See the last 20-year returns on the equity index. On the same time period, see the average last 20-year government bond yield, or the 10-year government bond yield, or the 20-year government bond yield. Take the difference between the mean return on the index and the average risk-free rate, and that will give you your equity risk premium. That is, on an average, equities have given so much additional return over and above the risk-free rate. The strengths of this approach are definitely the objectivity and simplicity, easy to explain, easy to calculate. Last 20 years of equity index data will be very easily available. If investors are rational, which is a big assumption, then historical estimates will be unbiased and will actually give us the correct equity risk premium. There are many problems, however, with this approach. First of all, mean and variance are not constant. Whether we take a 5-year period or a 10-year period or a 15-year period may significantly affect our calculation. The equity risk premium has seen to be counter-cyclical. What this means is that during good times, the equity risk premium is seen to come down a little, and during bad times, equity risk premium goes up. That is, in good times, even at high markets, people want to invest, or the discount rate that they are applying is very low. So the risk premium, that is RM minus RF, is much lower. Whereas in bad times, even with depressed markets, people don't like to invest. That is, they are applying such a high discount rate to calculate the fair value of stocks that even with a depressed market, the buy point is not being triggered. Or in bad times, RM minus RF goes up, the ERP goes up. If we simply use a historical estimate based approach, then we will be ignoring this factor, because we will just take the average and apply it in our calculation. We would not account for the cyclicality in the equity risk premium. There is survivorship bias. So the index only contains survivors. A stock that does not perform well, or that is an underperforming asset, is generally across the world removed from the indices. So the returns on indices may be upward biased because companies that have gone bankrupt or companies that are no longer in the index are not included in the calculation. So only the survivors are coming in our 20-year returns, hence equity returns may be biased upwards. Should we use the geometric mean to calculate the average, or should we use the arithmetic mean? Whatever you do, you should be consistent. Geometric mean would be calculated as 1 plus R1 into 1 plus R2, so on and so forth, into 1 plus Rn whole to the power 1 by n minus 1. Arithmetic mean will be calculated as simply R1 plus R2 plus R3 divided by n. You can use either of the methods, but make sure you use the same method for every index and for the risk-free return as well. And the question is, which risk-free rate to use? Should you use the 1-year T-bills? Should you use the 10-year government bond? Or should you use some other security? Because all of them are government bonds. All of them are risk-free. So you have to decide which rate is actually the risk-free rate of return. The first approach was the historical estimates. The second category of approaches deals with forward-looking estimates. So we compute the implied return on the market from forward-looking estimates. There are various forward-looking estimates also that can be used. The first is the Gordon growth model, that says that take any diversified equity index, the price of the index would be listed, would be available. the expected dividend yield can be calculated from the expectations of the dividends of the individual stocks, divided by the return on market that needs to be calculated, minus the growth rate in dividends, G. The price of the index from the Gordon growth model that we studied at level 1 would be D1 upon KE minus G, where KE is the required return on equity. So we do need to estimate G, and if it is a developed market which is expected to grow at a consistent growth rate for extended period in time, then we can compute the value of RM, or the required return, as D1 by P naught plus G. So we just take this side, we bring this down, and RM will be D1 by P naught plus G. So the implied return on the market comes out to be D1 upon P naught plus G. D1 is the dividend yield of a diversified index. P naught is the price of that index. G is the expected growth in earnings till sustainable future. Weakness is that the forward looking estimates will change through time. So our expectations of growth, dividends would keep changing, and hence the equity risk premium will also keep changing. And the big issue is understanding or fixing this infinite growth assumption. So G is the rate at which the firm is expected to grow, or the country rather, or the diversified index in this case is expected to grow till infinity. So guys, we are trying to estimate the risk premium. This is the return on equity. The risk premium is the required return on equity minus the risk-free rate. So this is what we just estimated as our risk premium minus the risk-free rate. So the risk-free rate is the long-term government bond yield. The 10-year bond or the 20-year bond yield is what is being taken as a risk-free rate. This will give us the risk premium. Now for many countries, computing and applying that sustainable growth rate assumption may not be the best option. So what we do is that we estimate 3 growth rates. G1 is the rapid growth rate, maybe coming for the next 5 years. A transition phase from developing to developed, wherein the economy has developed but it's still growing at a relatively higher pace. So a G2 for another 10 years, let's say. And then a mature slow growth till infinity, that is G3. We keep the discount rate the same, or the discount rate is what we need to compute. So the price of the index is known. The cash flows in the next 3 stages are also known because growth assumptions have been decided. Unlike the Gordon growth model, the growth assumptions are not exactly the same. So a high growth, a medium growth, and a low growth phase. The price is known, the growth is known, the cash flows are known. There is still only one unknown, that is the required rate of return or the discount rate. So the calculation will not be as simple as it was in the Gordon growth model, but with the help of a computer or a spreadsheet, it can easily be calculated that what is the discount rate that makes the present value of the cash flows of the index equal to the current price of the index. So this is another application of the Gordon growth model, wherein in the mature stage we will apply the Gordon growth model as is. In the transition and rapid stage we will explicitly forecast the cash flows and then try to compute the expected market return. The equity risk premium would be the return on the market minus the risk-free rate. All the growth estimates are estimated by us. RM, discount rate, is derived. The next forward-looking estimate comes from the macroeconomic model. So the macroeconomic model says that the return given by equity or the return given by any index can be broken up as dividend yield and capital appreciation. Dividend yield can be forecasted and capital appreciation can be further broken as that coming from earnings growth and that coming from revaluation or changes in the PE ratio. So if a stock was 100 and it becomes 110 and the total return was 15%, that is, it also gave a $5 dividend, then what is happening is that $5 is cash being paid out and that's adding to our return. If stock is becoming 110 from 100, two things must be happening. Let's say this 10 was an earnings of 10 and a PE multiple of 10 times, giving us a price of $100. If next year for some reason people are valuing the stock at 110, one of two things must have happened. Either these earnings would have become $11, that is, the earnings would have gone up by 10% and the multiple remained the same, or it's possible that the earnings didn't change but the people's outlook on the future became better, so the multiple that they were giving became 11 and the value was 110. A bit of both could have also happened. So this became 10.5 and multiple also became 10.5. This will again approximately give us a value of 110. So if capital appreciation is happening, it's either because earnings are growing or because the valuation multiple is increasing or the valuation is changing. So the earnings growth for the country as a whole or for the index as a whole will be linked to the GDP growth. So the earnings growth can be estimated as the GDP growth plus the expected inflation. So I plus REG would be the earnings growth estimation. Inflation in the macroeconomic model is the yield on 20-year treasury bonds minus the yield on 20-year TIPS. TIPS are inflation protected bonds. So the yield here will be the real yield and the real yield here will be the nominal yield. The nominal minus the real is nothing but inflation. And the expected changes in PE ratio depends on the analyst's judgment. If the analyst feels the market is undervalued, then he'll probably build in some growth or some increase in the PE ratio. If he thinks the market is overvalued, he'll probably build a negative number or a negative return because of this change in PE ratio. So the macroeconomic model says that the return on the market can be estimated as capital appreciation plus dividend yield. Capital appreciation can be broken up as the earnings growth plus the increase in PE ratio or the increase in valuation multiple. So if we know the expected inflation and we know the expected GDP growth, then this is the expected earnings growth for the economy as a whole. And if the stock market is a good indicator of the economy, then the stock market's earnings should also grow by so much. Change in PE ratio is estimated by the analyst plus the dividend yield that can be known from the stocks present in the index minus the risk-free rate will give us the equity risk premium. Now, the growth in GDP, as we will see in economics, can be further broken up as labor productivity growth rate plus labor supply growth rate. So why does the GDP grow in any country? Either more people are working or the same people are working better. Same people can be working better if they have more machines, if they have better technology, if they have better skills. So the expected inflation is known, the GDP growth can be estimated, the change in PE ratio is further estimated by the analyst, and the dividend yield can be estimated from the dividends that the index is expected to pay out. Generally speaking, the macroeconomic model will work only for developed markets because of the assumption that the real GDP growth is going to mimic the earnings growth of the index. So what we are inherently applying is that the index captures the entire economy, or all companies in the country are listed, because index will only have listed companies. In developed markets, generally all big companies will be listed. In developing markets, there may be many big companies that are not listed, or even if they are listed, they are a very small part of the index because there is no free float in those stocks. So in developing markets, the GDP growth can be very different from the earnings growth in the index, and hence this model will not be very good. So in the macroeconomic model, we compute the expected return as capital appreciation plus dividend yield, and capital appreciation is estimated as a product of the change in earnings multiplied by the change in valuation. Change in earnings comes as inflation plus the real GDP growth, and change in valuation is estimated by the analyst. The last forward-looking estimate, or the forward-looking method, is doing a survey or using survey estimates. So this just says that ask few intelligent people what they think the risk-free rate is, take an average of what everybody is saying and use that as your risk premium. So the eventual idea is just to estimate RM minus RF. So survey estimates are also easy to obtain, but different people and different organizations can have varying opinions. So please note, the objective of the models we studied in the last few slides was only to estimate the equity risk premium. In the coming session, we will apply the equity risk premium to calculate the required return on the index, or to calculate the required return on equity for individual stocks. Now, the first model that we will use to calculate the required return on equity, that we've studied at level 1 as well, is the capital asset pricing model, that says that the required return on the stock is simply the risk-free rate plus beta times the equity risk premium. Beta can be calculated as the covariance of the stock with the market divided by the variance of the market. It can also be calculated as the correlation of the stock with the market multiplied by the standard deviation of the stock divided by the standard deviation of the market. The current expected risk-free rate is 5%, the equity risk premium is 8%, and the beta is 0.5. Calculate the required return on equity. So the return on equity will be RF plus beta times RM minus RF. RF is given to be 5, beta is given to be 0.5, and RM minus RF, that is the risk premium, is given to be 8. So this will come out to be 9%. At level 2, we will delve deeper into more different methodologies of calculating the required rate of return, because the CAPM, as we studied, works only under a very limiting set of assumptions. So when we derived the CAPM at level 1, we assumed riskless borrowing and lending is allowed, capital markets are perfect, there are no brokerages, transaction costs, etc. As we relax these assumptions, the model will become more complicated and it will have to adjust many more things. In multi-factor models, we tend to have greater explanatory power than the CAPM, which is just a single factor model. So in a multi-factor model, return on market will go as one factor, or equity risk premium will be one factor. There can be other factors also related to the size of the company, related to the liquidity of the stock, related to the general market conditions, etc. So multi-factor models, the required return is again the risk-free rate plus beta 1 into equity risk premium 1, beta 2 into risk premium 2, so on and so forth. So the risk premium is the factor sensitivity multiplied by the factor risk premium. So we'll understand some multi-factor models. The first is called the Pharma French model. The Pharma French model says that the return on a particular stock is calculated as the risk-free rate plus beta times RM minus RF. So up till here, it is the same as the CAPM. After which, the Pharma French model says that the risk premium also depends on whether the company is small or big. So plus beta times the return on small companies minus the return on big companies. So generally it is seen that small companies outperform big companies by about 5%, for example. So RM minus RF will be 5%. Now depending on whether your company is small or big will be the value of beta. So if your company is small, then this value will be positive. If your company is an average size, that is neither small nor big, then the beta will be 0. So the baseline value of this beta would be 0. So the return not only depends on your market risk, it also depends whether you are a small company or a big company. Generally small companies outperform by about 5%. So depending on whether you are small or big, your required return will be higher or lower. So if you're a small company, then you are expected to deliver a higher return because the risks associated with smaller companies are also higher. They go bankrupt, they can shut down easily, and you can lose all your money. So this beta would be high number for a very small company. Similarly, the expected return also depends on your valuation. The valuation that Pharma French used was the book to market value. So generally speaking, high book value to market value companies outperform low book to market value companies. Please note, book value to market value is the reverse of the price to book multiple or the price to book ratio. So if a company has a book value of $100 and a market value or a market cap of $100, then the book to market ratio is 1. That means this is how much shareholders have invested in the business. Book value is what the shareholders have invested in the business or what the company has retained from the shareholders, and market value is the current price. If book to market value is high, that means the company is undervalued, or let's say it has a lower valuation. If book to market value is low, that means book value is 100 and market value is 500, so it's only 0.2. That means the company is probably overvalued or potentially overvalued because shareholders have invested 100, and for the shareholders' investments, market is today willing to pay 5 times that. So it's the inverse of the price to book multiple. So generally, for example, Pharma French found that undervalued companies outperform overvalued companies by 2%, or RHBM minus RLBM is 2%. So depending on whether you are a undervalued company, that is whether you have a high market to book value ratio, or whether you are a overvalued company, that is you have a low book to market value ratio, then will decide your beta. So if beta is 0, that means you are an average valuation. You're neither overvalued nor undervalued. If you are undervalued, then beta will be positive. So the required return is not just dependent on the market risk premium. Pharma French also gives a small company premium. It also gives a valuation premium to less valued companies. Now you may not agree with this model. You may want to put in more factors also, as many other researchers after Pharma and French did. But please note, you have to remember this model. This is the model given by Pharma and French in trying to explain the expected returns from a stock. Let's do it with an example. Please remember the baseline value of beta market is 1, that is an average risk company. Beta HML and beta SMB are 0, that is an average size company and an average valuation company. Assume that the market provides the following values for the factors. The equity risk premium is 5%. The small minus big premium is 6%. And the high book to market minus low book to market value premium is 7%. The risk free rate is given to be 3%. An associate, Mohan Madan, estimates that stock J has a CAPM beta equal to 2. Using the Pharma French model, the associate estimates the following betas for stock J. So the beta for the market is 2. Small market cap beta is 1. High book to market beta is -1. Calculate the required return on equity using the CAPM and the Pharma French model. So let's first do it using CAPM. The risk-free rate is given to be 3%, beta is given to be 2, and RM minus RF is given to be 5%, so this comes out to be 13%. Using Pharma French, the risk-free rate is 3. The beta for the Pharma French will be different, because when we do this regression, the beta may come out to be different. In this example, it is the same, but it may not necessarily be the case. So you'll have to estimate a separate beta for the Pharma French model, which comes out to be 2 into RM minus RF is 5 plus 1 into R small minus R big. So this company is probably a small company, hence it should give a 6% additional return, and it is generally overvalued. That is, it has a -1 exposure to the high book to market ratio. So then the return requirement becomes lower to the extent of -1 into 7%. Hence the required return on equity comes out to be 12%. The third multi-factor model, or the second multi-factor model that we will study, is the Stambog model. So this model is the same as the Pharma French model that we studied earlier, only it adds one more factor of liquidity to the Pharma French model. So the baseline value for the liquidity factor beta is 0. Less liquid assets have a positive beta, while more liquid assets have a negative beta. So to the Pharma French, we will add just one more, that is beta multiplied by the liquidity risk premium. So illiquid stocks outperform liquid stocks by a certain percentage, or illiquid stocks have higher risk, hence they should be required to give a higher return. If your stock is illiquid, then this beta will be positive. If your stock is liquid, then this beta will be negative. So assume a liquidity premium of 6%, the same factor risk premium as before, and the following sensitivity is for stock K. Calculate the cost of capital using the Stambog model. So 3% was the risk-free rate of return. The market risk premium was given to be 5%, so it will be 2 into 5 plus 1 into 6 minus 1 into 7. This is all the same as before, minus 0.5 into 6. So ours was probably a liquid company, hence there was a negative beta applied and a premium of 6%. It was an illiquid company, the liquidity beta would have been positive. So this will come out to be 9%. Please note, I do not expect questions like this to come on the exam, but conceptually your understanding of Pharma French model and Stambog model may be tested. So it's quite simple. You just need to understand that additional premiums are given to illiquid companies, to small companies, and to undervalued companies. They should give a higher return, or their required return on equity should be higher according to the Pharma French and the Stambog models, which are multi-factor models. The next category of multi-factor models is the macroeconomic multi-factor models. So macroeconomic multi-factor models say that equities deserve a risk premium, or the required return needs to be higher for all the risks that the investor is taking. So investor assumes a confidence risk, that is the unexpected change in the difference between the return on risky corporate bonds and government bonds. So credit spreads may increase, or the yields on corporate bonds may increase if the confidence in the economy is not very good. So if the confidence in the economy goes down, then the value of equities again goes down. So that's the risk I'm taking. I should be given a return, or I should be compensated for this risk. There is a time horizon risk, that is the difference between the return of long-term government bonds and treasury bills. So if long-term rates go up, equity values are calculated by discounting long-term cash flows. Then that is additional risk, because there is no guaranteed fixed return that I have been promised. So my returns can vary as the confidence in the economy changes, as the confidence or the outlook or rates at different time horizons change, as inflation changes unexpectedly. So if inflation is unexpected and my company is not able to pass it on, then again the value of equity will reduce, because the discount rate will go up because of higher inflation and my earnings may not. There is business cycle risk, that is unexpected change in the level of real business activity. Could be for any reason, bad government policies or low demand or some natural disaster. So there is confidence risk, there is time horizon risk, there is inflation risk, there is business cycle risk, and there are other risks also. So we'll define market timing risk as the other risks that cannot be attributed to any specific factor, but that, or we'll call market timing risk as the residual risk that is there in equities. So in the past, if we see, the returns can broadly be explained by these four risks and some other variability that we refer to as timing risk. So the macroeconomic model says that the sensitivity to each of these risks should be calculated, and then the required return would be equal to the risk-free rate plus the sensitivity multiplied by the premium for each of these risks. So assume the following values for the factors. So confidence risk deserves a premium of 4% on an average, time horizon 5%, inflation risk 6%, so on and so forth. Assume the following sensitivities of a particular stock to each of these risks. Using a risk-free rate of 3%, calculate the required return using a multi-factor approach. So it's the same application exactly. Risk-free rate plus beta multiplied by the premiums, and the answer will come out to be 12%. The last approach is referred to as the build-up method, which is similar to the risk premium approach, and it is normally applied to closely held companies or private companies where betas are not readily available. So what we generally say is that the required return is the risk-free rate plus an equity risk premium plus a size premium plus a specific company premium. Rather than doing a beta multiplied by the average premium, we calculate it specifically for the company in question, because betas are difficult to estimate for these companies. In the other methods also we applied similar premiums, but we first calculated an average and then we saw this company's sensitivity to that average. It could be higher or it could be lower, it could be positive or negative. Ranchi Motors has bonds with 15 years to maturity. They have a coupon of 7% and a price equal to 105. An analyst estimates that the additional risk assumed for holding the firm equity justifies a risk premium of 4%. Given the coupon and the maturity, the yield to maturity is 9%. Calculate the cost of equity using the bond yield plus risk premium approach. So in the bond yield plus risk premium, we just calculate the yield to maturity on the traded bonds of that company. And we see that if bonds themselves are trading at a yield of 9%, then if I'm investing in the equity of this company, I would want a higher return than 9% because the bondholder is guaranteed payments and is probably guaranteed some collateral also. So if I invest in the company's equity, it has to be at a premium. If the equity is giving you less than that, you are better off investing in the bond. So the 4% is the estimated risk premium that equity deserves, or the required return on equity using the bond yield plus risk premium approach will be 13%. Now it has been seen, or rather it is recommended, that we adjust beta for something called as beta drift. Beta drift is the tendency of betas globally to revert to a value of 1. Now why this happens is that because in the initial stages of any country or the development of any country, there is a lot of volatility. Betas tend to be really high because in some sectors there is too much competition, in some sectors there is no competition. Economy is still emerging, people are still evaluating, more and more businesses are still sprouting up. As the economy develops and matures, all sectors mature. That is, unwanted players are weeded out and markets develop into oligopolies. There are 4-5 big companies that are established, which are now growing at the rate of growth of the market because the product has been delivered, rather the product has been discovered, and the stability in the economy is now higher. So as an economy develops, betas tend closer to 1. Now betas calculated over the last history or over the last 10 years may be very high. We'll call them as the regression beta. But when we are calculating the risk premium or the equity risk premium, then that discount rate calculated from the equity risk premium is applied in valuation for the next 1 year or for the next 20-30 years. The discount rate that you will calculate today using any of the approaches that you studied will generally be applied over a longer period in time. So even though the current beta would be a regression beta, to fairly account for the risk and to fairly account for the long-term discount rate, you should use the adjusted beta in the calculation. That is, 2/3 weight you still place on your calculated beta or the regression beta, and 1/3 you should place on the value of 1, which is where betas have been seen to be trending towards as economies mature. So in the beta calculation, use 2/3 of your calculation and 1/3 of 1. Assume an analyst estimates the beta equal 0.6 using regression and historical data and adjusts the beta as described previously. Consider the adjusted beta and use it to estimate a forward-looking required return given the risk-free rate is 3% and the equity risk premium is 5%. So the adjusted beta would be 2/3 of the regression beta plus 1/3 into 1, which will come out to be approximately 0.7333. that is, it tends to be closer to 1 than our calculation. And then we can use it in the CAPM model to calculate the required return on equity. So it will be 3 plus 0.7333 into RM minus RF, which will come out to be approximately 6.65%. We studied at level 1 how to estimate betas for a project or for a private project. So we said take help of a listed company's beta and then make the adjustments. Betas for thinly traded stocks are also estimated in a similar manner. So the general calculation of covariance upon variance would not be correct or would not be very reliable if there wasn't a fair market price available, or if the stock was thinly traded and the prices could have been manipulated or could have been hugely volatile. So again, what is recommended is that identify a benchmark company that is a heavily publicly traded company that is similar to the company ABC whose beta you're trying to calculate. Then unlever the beta with the following formula. So the beta of the benchmark company, let's assume it's XYZ. So the beta of the benchmark company would account for the leverage of this company or the company XYZ. So remember, a part of the beta comes from the business itself. So real estate, autos, banking are relatively riskier businesses. If the economy goes up today, sales of autos, real estate go up. If economy goes down, these are the first things that people stop purchasing. So beta, that is the risk of the business, can be higher or lower than the average market because of the business itself. Other businesses, FMCG, pharmaceuticals, have lower business risk. Today, if the economy goes into a boom or a recession, you won't stop taking a bath, or you won't start bathing 10 times because the economy is in a boom. Similarly, you won't start or stop eating medicine depending on the state of the economy. So this business per se, or some businesses per se, are less risky as compared to the others. So part of the risk comes from the business itself. A part of the risk comes from the leverage in the company. That is the amount of debt the company has taken. Between two pharma companies or two FMCG companies or two real estate companies, the company with the higher debt will have more volatility in earnings and more volatility in stock prices because of the concept of leverage that you studied at level 1. So the current beta that you will calculate from the market using covariance upon variance for the company XYZ would be accounting the leverage of the company XYZ. So the first thing we do is we unlever the beta so that we can use our leverage of the company ABC. The business of company ABC and XYZ is very similar. So both are real estate companies or both are FMCG companies. Apart from the leverage, the risk of both companies is the same. So we will first try to calculate that risk of the business, also referred to as asset beta, and then compute the beta for ABC. So compute the beta of XYZ and unlever the beta. Unlevered means divide by 1 or multiply by 1 upon 1 plus the debt of XYZ upon the equity of XYZ. If the debt was anyways 0, this number would have been the same. If debt is 0, this would anyways have been the same. Please note, the unlevered beta would normally be lower because you're taking away the risk. You're taking away the risk of leverage. So let's say otherwise the beta was 0.5 and a debt equity of 1:1, then the unlevered beta would be 0.5 upon 2, that is 0.25. So 0.25 was the risk of the business, and another 0.25 risk came in because of this 1:1 debt is to equity. So unlevered beta will be lower than the equity beta. This is referred to as the equity beta. This is the asset beta or the unlevered beta. But this is not the end. We then need to lever it back up for the leverage of our company or our thinly traded stock ABC. So if ABC also has a 1:1 debt equity, then it will again become 0.5. If ABC doesn't have any debt, then it will remain 0.25. So we will again do this unlevered beta into 1 plus the debt of ABC divided by the equity of ABC to compute the equity beta for ABC. So let's look at the strengths and weaknesses of the various models that we've studied. The CAPM is the simplest but may have low explanatory power in the real world. Multi-factor models have more explanatory power. They consider more aspects but are more complex and costly to create. Build-up models are simple, wherein we don't have beta. We just add a risk premium for the various risk exposures and can be applied to closely held companies, but they typically use historical values as estimates that may or may not be relevant to the current situation. So to calculate the size premium or the liquidity premium, it comes from the historical returns that illiquid stocks have given over and above liquid stocks, or what small companies have given over and above large companies. So those historical returns may not be very reliable for the future. If you're investing in international markets and international equities, then certain other considerations that you should be aware of. Firstly, the required return should reflect expectations for changes in exchange rates as well. So if you're expecting the foreign currency to depreciate, then your return will reduce, or that is another risk that you are taking, so you may want to put a premium for that risk. When dealing with emerging markets, another premium should be added to reflect the greater level of risk present. So there are two broad methods of estimating the size of this risk premium. The first model, we got a hint of this at level 1, was the country spread model, wherein we saw the yield, or wherein we used a developed market and computed the required return from the developed market, and then added a premium for the emerging market risk. And that premium was calculated by taking the difference of the yields on the bonds of the developing market, the dollar denominated bonds of the developing market, minus the yields of the bonds in the developed market. We remember we did the country risk premium is what we added. So this is the first model, he says. So you can use a similar model at level 2 as you studied at level 1, wherein RF is the same as the developed market. RM minus RF, that is the risk premium, is also the same as the developed market. And then we added a CRP. We called it the country risk premium. So that's the first method. What you can also do is apply a country risk rating model. So this model will estimate an equation for the equity risk premium for developed countries, and then uses the equation and inputs associated with the emerging market to estimate the required return for the emerging market. So use the same model, that is RF plus beta times RM minus RF, but instead of adding a country risk premium now, just use all these inputs from the emerging market. So use the emerging market risk-free rate, use the emerging market beta, use the emerging market risk premium, so that you don't have to add a country risk premium. Here we added a country risk premium because all these inputs came in from the developed market, and then we had to add a premium. So these are the two approaches in which you can incorporate international considerations into your required rate of return. Finally, the weighted average cost of capital is calculated as the weight of debt into the cost of debt into 1 minus the tax rate. This is because in most countries in the world, interest expense is a tax deductible expense, plus the weight of equity into the cost of equity. Please note, when you are computing the weight of debt or the weight of equity, it is always based on market values. So market value of debt upon market value of debt plus equity will be the weight of debt, and similarly the weight of equity. 1 minus tax rate, this is because interest is tax deductible. And you should be very careful about which discount rate to use. So the discount rate should correspond to the type of cash flow being discounted. If you're discounting cash flows available to the entire firm, that is cash flows available to both debt and equity, then you need to discount by the weighted average cost of capital, or the WACC. If you're discounting cash flows only available to equity, then these need to be discounted at the required return on equity. So that was the second reading in the review on equity valuation that dealt with return concepts. So we studied what required return is, we studied the risk premium, and we studied various methods of calculating the required return, that is the CAPM we revised, and the multi-factor models of Pharma, French, Pasteur, Stambog, macroeconomic multi-factor models. And we saw the strengths and weaknesses of each model, the weighted average cost of capital, and related concepts.